guys, so today I'm about to teach you exactly how fair value gaps work and a lot of stuff that is kind of being gatekept in the industry, or maybe they just don't have the knowledge. So let's hop in there so I could flex on you with some of my trades. Here's exactly three trades I took today. I took another trade over here. I got stopped out because I got into this trade a little too early. But anyways, I was up for the day using the knowledge of fair value gaps. So let's get right into it. Before we start, I want to explain to you exactly what a fair value gap is. So what it is three consecutive candles where the wicks do not align. So if we look at this candle right here, the middle candle, the candle to its left, the wick up, and the candle to its right, the wick down, does not align, and it creates a little gap. I hope you guys can see that. Here, I add like another box right here. Let me change the color. As you guys can see, this in itself is a fair value gap right there. So if we go over to this chart, you can see that there's many fair value gaps everywhere. So there's a fair value gap right here, right? There's a fair value gap right there. And this is something that you won't be able to see off the start. It's trained. You basically train your eyes to see it. When I first started trading, the way that I trained my eyes to see these patterns is I use the indicator called FEG Nephew Sam. So if I get rid of, let's say, my daily profile thing, kill it, search and destroy. If we go over here, we click FEG Nephew Sam, a lot of these fair value gaps are already being shown. The reason why I don't really use it is because look at all this garbage on your screen. Sometimes a fair value gap isn't gonna be working. It just it's gonna get ran through, and I'm about to teach you exactly how to know when that's about to occur. So let me get rid of this stinky indicator, and let's hop back into the concept. So what happens when you have a fair value gap? Let's look at this right here. This is a bullish fair value gap because we are moving up. So I could literally change these candle colors to be green. You have this bullish fair value gap. What would occur? So basically this fair value gap formed because in this area right here, there were no sells. It was a very strong push upwards, followed by another kind of strongish push, and it created a gap in the market where there was no sells. So what would happen is this becomes now a magnet for price. There are two things that could occur. Price could consolidate a bit, maybe go up, high, upper, lower, down, and touch back into this fair value gap and bounce off it. It gained more price and went off it. Or it could do random stuff right here, come down and run through it and inverse it. So if it doesn't bounce off, if it bounces off, it's a fair value gap that got respected. If it goes through the fair value gap, it got disrespected, and now it becomes an inverse fair value gap, which is kind of a zone of resistance. Yeah, so let's look at this. Let's change this to be an inverse fair value gap. What we might see happening, and we could take trades off it, is it's gonna go here, bounce off, maybe retrace back into a bounce off, etc. Right? As you can see, that's what happens. And one thing you guys have to note is that the higher the time frame of the fair value gap, the more likely it is to move. So the higher the time frame, the better it is. So how did I trade today using these fair value gaps? Well, originally my bias was based off of an inverse fair value gap on the 4 hour. So we see this inverse fair value gap, we move before market open at 1 a.m., 5 a.m. Do you see market didn't open yet? We kept seeing that this fair value gap kept getting wicked down. So this inverse fair value gap was being held. That was one indication of a bearish movement. We zoom in further. We see that we were in a bearish order block as well. We were respecting it. We zoom in a little bit more. We see another 15-minute bearish order block. We were respecting it. Everything was aligning. So I don't know if there was any SMTs. I don't remember. Yeah, I don't think so. But that all added up to my short. And I actually called this out on my Discord server, link in description. So using that knowledge that I just gained, we know that fair value gaps, like an inverse fair value gap, could be a zone of resistance and it could start bouncing down. Now let's go in to the 5 minutes. Let's see, what do we see? So in the 5 minutes, we had wait, not 5 minutes, sorry. Was it the 3 minutes? Okay, so in the 3 minutes, we had a break of structure, and on the break of structure, a fair value gap was formed. You can see over here, there's a fair value gap. This was my entry. I saw that we retraced into it, and a fair value gap only gets inversed if we close above it. So this wick didn't really inverse a fair value gap. It's actually getting respected. So I see this big wick down, and I'm starting to see, okay, this fair value gap might hold some power. I place my shorts, all right? And I target these lows because, I don't know, I just felt like it will go down there. But also, to make sure I minimize risk, I also had partials right here. And yeah, I re-entered over here because of another fair value gap. It was actually on the 5 minutes, I believe. I don't remember. This was in the morning. No. It was on the 3 minutes. I entered off of the 3 minute fair value gap. Or 1 minute? I genuinely forgot. But either way, a 3 minute fair value gap would have worked too. Yeah, see that 1 minute fair value gap? We kind of touch back into it. And another thing you have to also look out for is inverse fair value gaps. So not only do we know if it's a zone of resistance, but also it tells us if the market is shifting direction. So if we see a lot of inverse fair value gaps in the bearish direction, or yeah, see over here how we inverse this fair value gap. There's a fair value gap, and we kind of disrespected it. This is showing us that our bears are kind of starting to overpower the bulls. So boom, we see that we inverse that, and you see it pooped itself. I didn't hold all the way there. My standard deviation was telling me to take full profit over here at -4, but as you can see, we started going down. Now again, where was my second trade? So this trade right here, what did I look at? So boom, we saw a high time frame order block right there. We saw SMT right there. We saw that we inversed the fair value gap, bearish fair value gap. We're starting to pick up bullish movement. And then what else do we see? Where is it? What did I enter off of again? Okay, what do we see? We see this order block starting to be respected, and then I just kind of entered off of the touch into the order block, and yeah, we also kind of wicked into this fair value gap right here. All of this is showing me bullish movement. I kind of waited. Wait, I actually traded around here. I kind of waited for a little bit of movement off of that fair value gap. We started moving upwards, and then boom, we started shooting up. I took profit there because of my standard deviation that you saw before. Now, this is something that is pretty well known. Everybody knows what I just taught you, or most people know what I just taught you. If you didn't know this, then you're welcome. You know, I just helped you out. But there's a few more things about fair value gaps that we have to look at. And this is why I kept it to the end, because of the inexperienced traders. I just kind of taught them, and also I'm weeding out the people that have monkey brain and cannot actually pay attention. So if we look at this fair value gap right here, or the fake one that I drew out, we could break up this fair value gap into sections, right? So the first section we could break it into is a half. So let's go into the settings. Let's add a midline. We broke it up into 2. So why did I break it up into 2? Because what I've noticed, or what ICT teaches, and this is his concepts, the half of this fair value gap, the top half, is where it's most likely gonna start getting respected. So if we see a move down into this fair value gap, most likely, if it starts respecting on this half point, you're gonna expect it to shoot up. That's just my rule of thumb. If I see that's respecting the top half, I expect it to keep going up. Well, another thing what you have to notice is that this fair value gap, not only could it be broken up into halves, but it could be broken up into quarters. So if I take my Fibonacci sequence and you could copy these numbers on your Fibonacci, it could be broken up into quarters. So what happens sometimes is we see a fair value gap, and then it just wicks these lines and blasts up, right? So like, let's say it was like this, it could have been like that, it could have been like that. And another thing that a lot of people don't know is that if let's say for example, we have a close on this fair value gap like this. Let's say we're closing on this fair value gap. Let's make this red. Let's make this red. Let's say we close in this fair value gap like this, and just a little over. You probably don't know this, but this fair value gap still could be active. We could still have bullish movement off it because it's a mohawk. So the best way that ICT described this was, you wouldn't punish your child for coloring outside the box. Yes, the market is a very precise place and everything has a reason for it, and it just like, it moves pixel perfect sometimes. But other times, what might happen is we will color outside of the box. So if you give your kid a coloring book, they come up to you, they're like, hey dad, I colored this for you. You're not gonna beat up your kid just because they colored a little bit outside of the box. Yes, this would be a little more unlikely to hit, but you still have to, let's say you're bullish, you still have to see it in a bullish lens. Don't just immediately assume that we're gonna be bearish just because we kinda close below it. It's a mohawk fair value gap. It's still gonna continue. It might continue going up. Chances are lower, but there still are chances, right? So now you learned a lot more than most people know. Now I'll give you guys even more sauce because I want everybody to be eating, and I'll give it to you all for free just for a simple follow. So let's say we had a gap in the market. So this happens a lot. This is called a volume imbalance. The way I have my fair value gap drawn here is wrong. It's completely wrong. Yes, the average person might think, or let's actually do something for you. Let's say there was actually a wick right here. And let's say I drew it like this. It's still wrong because look at that volume imbalance. We have to make up for the volume imbalance. So if you ever see a volume imbalance like this, your fair value gap would look like that. You just kind of bring it up to this volume imbalance. Okay? So that's another thing most of you probably didn't know unless you watched one of ICT's long ass videos. Another thing, and again, here's the sauce. You know, you people would probably charge you a lot of money for this, but I'm doing it for free. Another thing that you have to take into consideration is that fair value gaps are more likely to get hit if we are in a like equilibrium, right? So if we have, let's try to find a good example. One sec, I'll probably cut this part out if I don't get these. So let's say we're told that we have an equilibrium right here, right? This is probably a higher time from equilibrium, right? Or even, okay, let's say this is the swing low and that's the swing high, right? That's the swing low and that's the swing high. How do we know which fair value gaps are going to be hit? Because there's many that are forming right now on my screen. How do we know which ones are going to be hit? Well, we look at which one is in discount, heavy premium. So if I'm going short, I'm looking for premium, right? So let's adjust this to be our time frame. So around the 3 minutes, let's adjust this to be our time frame. Let's say this is the swing low, or we do it for the past one. So let's say this is swing low and that's the swing high. The top of this box is a premium. The bottom of this box is a discount. So if we came up into this premium right here, fair value gap, we can expect that this one will have a stronger bearish movement, right? But see how we formed another fair value gap? Sometimes it doesn't matter. You could be in discount, but it's going to keep it going down. But that's just a way to tell which fair value gap will be stronger. So in this case, I just saw a strong movement off of this fair value gap, so I just left it as is. But again, that is a discount for another movement. So at a higher time frame movement, that is in discount. And it just kind of it takes a little bit of practice. You have to you can eyeball it too. You don't really need the drawing that I or like the thing I just showed you. You don't really need that. You can just eyeball it. So let's look at this 3 minute fair value gap right here. Is that in discount or in premium? Let's take a look. You see it's in discount. We tapped into that fair value gap. We wicked into it. And again, it's all starting to align. We wicked into it into the top half of this part. Right? The top half. Not the bottom half. The top half, right? When I told you if we see a wick into it and an expansion up, most likely it's going to start getting stronger. We have an SMT. We have an order block. We have an inverse fair value gap. We have a fair value gap that got touched into, and it's in discount, and we respected the top half of it, and we're moving up. You buy it, it's going to hit your TP. Don't only trade off of fair value gaps. That's something a lot of newbies do. They pick two confluences, liquidity sweep, fair value gap, and they just only trade that. Yes, technically you will have a win rate. Maybe it's gonna be high, maybe it's gonna be low, depending on your psychology and how you trade. But if you want to actually increase your win rate and you want to actually get better at trading, mix these confluences up. Don't only focus on one. Mix it up. Add a bunch together. The more you have together, the better it is. It's kind of like a detective. They can't just use one clue to solve the case, right? They need multiple clues. They need multiple reasons, intent. I don't know. I'm not a detective, but they get a lot of stuff together to get the final answer. This is a 20-minute video about fair value gaps. I just dropped my heart and soul into this. In return, I want you guys to subscribe, leave a like, and to those of you that are actually trying to get better at trading, I recommend you join my Discord server. Okay, it's free. It's completely free. I don't charge anything. And it's just a community. We're all trading. We're all trying to make profits together. We're all helping each other out. And if you are interested in that, drop a follow and join up. Anyways, I'm not going to chew off your ear. I hope you have a great day. I hope trading works out for you guys. And watch this video to see my strategy. And see ya.